Do you remember 2008? For some, it might just be another year. But for many, it was the year the world economy almost collapsed. Today, we're going to unravel the story of the 2008 global financial crisis, a modern-day financial thriller that changed everything. And don't worry, I'll break it down so it's easy to understand. No finance degree required. So, where did it all begin? Believe it or not, it starts with something that sounds pretty safe. The American dream of owning a home. In the early 2000s, interest rates in the US were super low. This made borrowing money really cheap. Lenders started handing out mortgages like candy, even to people who, honestly, probably couldn't afford them. These were called subprime mortgages. Think of it like this. A bank gives a loan to someone with a shaky job and a poor credit history. It's a risky bet. Now, why would banks take such a huge risk? Because they weren't holding on to these risky loans. Instead, they bundled them all together. Imagine making a giant fruit salad. You take thousands of these mortgagees, some okay, and a lot of really risky ones, and mix them all up into a new financial product called a mortgage-backed security, or MBS. Investment banks then bought these MBSs and sliced them up into even more complex products, called collateralized debt obligations, or it's like taking that fruit salad, blending it into a smoothie, and then separating it into different layers. The top layers were rated AAA, supposedly super safe, like government bonds. The bottom layers were These CDOs were then sold to investors all over the world. Pension funds, other banks, even entire countries. Everyone wanted a piece of the American housing market, which seemed like it could only go up. The credit rating agencies, the supposed referees of the financial world, gave these products top ratings, making them seem incredibly safe. It was a money-making machine, and everyone was getting rich. Wall Street was having the party of a lifetime. But here's the catch. The whole system was built on a very shaky foundation. The assumption that house prices would keep rising forever. And for a while, they did. People were buying houses, flipping them for a profit, and the cycle continued. It was a massive housing bubble. Then, things started to go wrong. Those low introductory interest rates on the subprime mortgages began to reset to much higher rates. Suddenly, homeowners who were barely making their payments found their monthly bills skyrocketing. People started defaulting on their loans. They couldn't pay, and they couldn't sell their houses because the market was flooded. As more people defaulted, the value of those mortgage-backed securities and CDOs began to plummet. Remember that fruit salad? The risky fruit was starting to rot, and it was contaminating the whole bowl. The Saif AA-rated investments were suddenly revealed to be full of toxic debt. This is when the panic set in. Banks and financial institutions realized they were holding trillions of dollars worth of assets that were now essentially worthless. They stopped trusting each other. No one knew who was holding the bad debt, so they stopped lending to each other. The credit markets, the very lifeblood of the modern economy, froze solid. The dominoes began to fall, fast. In March 2008, the investment bank Bear Stearns, a Wall Street giant, was on the brink of collapse and had to be bailed out in a fire sale. But that was just the appetizer. The main course came in September 2008. On September 5th, Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It was the largest bankruptcy in U.S. history. Unlike Bear Stearns, the government decided to let Lehman fail, hoping to teach Wall Street a lesson. The effect was catastrophic. It was like pulling a critical Jenga block from the tower. The entire global financial system teetered on the edge of abyss. The day after Lehman collapsed, the insurance giant AIG, which had insured trillions of dollars of these toxic assets, was about to go under. If AIG failed, it would have taken countless other banks down with it. The U.S. government had no choice but to step in with a massive $85 billion bailout, which eventually grew to over $180 billion. The stock market went into a freefall. People's retirement savings were wiped out. Businesses couldn't get loans to operate. Layoffs swept across the country and then the globe. The financial crisis had morphed into a full-blown global economic recession, the worst since the Great Depression. In response, the U.S. government launched the Troubled Asset Relief Program, or TARP, a $700 billion bailout package to buy up toxic assets and inject capital into the struggling banks. The Federal Reserve slashed interest rates to zero and started a program called quantitative easing, essentially printing money to pump into the economy. Governments around the world took similar drastic measures. It was a coordinated global effort to prevent a total meltdown. It was messy, it was controversial, but it probably saved the world from a second Great Depression. So what were the long-term consequences? First, a wave of new regulations. The Dodd-Frank Act in the US was passed to increase transparency and prevent banks from taking on so much risk. It created new agencies like the Consumer Financial Protection Bureau to protect everyday people. Second, it led to a massive loss of public trust in banks, governments, and financial institutions. Many people felt that Wall Street got bailed out while Main Street suffered. This anger fueled political movements on both the left and the right, from Occupy Wall Street to the Tea Party, and its echoes can still be felt in our politics today. Third, the recovery was long and slow. While the stock market recovered relatively quickly, unemployment remained high for years. Many people lost their homes, their savings, and their sense of financial security. The crises left deep economic and psychological scars that haven't fully healed. Looking back, the 2008 financial crisis serves as a powerful cautionary tale. It showed how greed, a lack of regulation, and complex financial instruments that few understood could combine to create a perfect storm. It demonstrated just how interconnected our global economy is, and how a problem in one corner of the world can quickly spread everywhere. The story of the crisis is a story of human behavior, of hubris, of herd mentality, and ultimately, of the devastating consequences when a system designed to manage risk ends up creating it on an unimaginable scale. It's a complex topic, but I hope this breakdown made it a little clearer. Understanding what happened is crucial, because the decisions made in the wake of 2008 continue to shape our world today. What do you think are the biggest lessons we should learn from the crisis? Let me know down in the comments. Thanks so much for watching. If you found this video interesting, please hit that like button and subscribe for more deep dives into the events that shape our world. See you in the next one.